Welcome to Talk Tickers. We're your deep dive into the earnings calls that matter.
And today we're unpacking Hudbay Minerals, ticker HBM. They just reported their Q3 2025 results on November 12th.
Yeah, a major diversified miner, mostly copper and gold. And this quarter, it was quite the story.
Definitely. You had these really tough external challenges hitting them, hard wildfires, social unrest, things like that.
But at the same time.
But at the same time, they made some huge strategic moves, especially around de-risking their big Copper World project. So a fascinating mix.
Absolutely. That tension between the tough quarter operationally and the big long-term positive news created a really interesting market reaction.
It did. So where should we start? The headline numbers.
Let's do it. Got to face the initial reality check. They missed on the key adjusted number.
Right. Non-GAAP adjusted EPS, it came in at 3 cents. The market was expecting 6 cents. So yeah, 50% miss there.
And revenue.
Revenue also came in light. $346.8 million versus a consensus around $413 million. That's down nearly 29% year over year. Not pretty on the surface.
Oof. Okay, but you mentioned a different story underneath.
Yeah, and this is crucial. You flip over to the GAAP numbers, the official accounting earnings per share. It was $0.56.
Whoa. Okay, how do you get from 3 cents adjusted to 56 cents GAAP? That's a huge swing.
It is, and it's almost entirely down to one big non-cash item. A $322.3 million impairment reversal tied to that Copper World joint venture we mentioned.
An impairment reversal.
Yeah.
So basically, they'd previously marked down the value, and now accounting rules let them write it back up.
Exactly. It's an accounting adjustment, but it sends a massive signal, right? It says the underlying of value recognized for this key future asset just got a huge boost because of the new JV deal.
Gotcha. A non-cash boost, but a powerful signal about future value. Okay. But let's not gloss over the operational pain that hit the adjusted numbers and the revenue. What specifically went wrong?
Well, it really boiled down to lower sales volumes. And that wasn't really, their fault directly. It was these external shocks.
Like what?
You had social unrest in Peru causing operational interruptions at Constancia. And then up in Manitoba, they faced mandatory wildfire evacuations. Just tough luck hitting multiple places.
For things you absolutely cannot plan for. Did that hit cash flow too?
It did. Consolidated free cash flow was negative, about $15.2 million for the quarter.
Okay, that sounds concerning.
Well, yes and no. Management was quick to point out, and this is important, that a very large copper concentrate shipment from Peru, worth about $60 million, got delayed right at the end of September.
Just bad timing.
Just bad timing due to ocean swells at the port, apparently. It shipped in early October, literally days after the quarter closed. So that cash basically landed right after Q3 ended.
Okay. So the negative free cash flow number is a bit misleading then. The cash was essentially there.
Pretty much. And that context is key, especially when you look at their overall financial health. It's actually really strong.
How strong are we talking?
They finished the quarter with really solid liquidity. Over $1 billion, $1.04 billion to be specific, and that includes $611 million just sitting in cash.
Wow. And debt.
Very manageable. Their net debt to adjusted EBITDA ratio was only 0.5 times. That's quite conservative for a miner.
Okay, so they had this rock-solid balance sheet despite the operational hiccups.
Exactly. And that financial strength is what let them sort of frame the narrative not as a disaster, but as a quarter of resilience, as they put it. It allowed them to pivot the conversation towards the future.
And that future pivot, the market seemed to really grab onto the cost guidance news, right? That felt like the biggest positive surprise on the call.
Absolutely. This was, I think, the main driver for the stock reaction. They significantly tightened and lowered their full-year cost guidance.
Okay, break that down. What kind of numbers are we talking about?
So consolidated cash costs, it's basically the direct cost to get the metal out of the ground. They slashed that range. It was $7.55 to duly $5.85 per pound. Now it's just some of that are in 60 cents to 35 cents per pound.
15 to 35 cents. That's a massive drop.
Huge. And then the all-in sustaining cost, or AISC, which includes sustaining capital and other things, that also came down significantly from a range of $2.25 to $2.65 down to $1.85 to $2.25 per pound.
Okay, those are genuinely impressive reductions. But the key question is always why, isn't it? Is this sustainable efficiency or is something else going on, like maybe high gold prices helping out?
Yep. Hudbay produces a lot of gold alongside its copper, especially in Peru. Gold prices have been very strong, as you know. So the value of that gold gets credited against the cost of producing the copper. It effectively makes the copper cheaper to produce on paper.
So it's a real benefit, a great hedge even, but maybe not entirely down to just operational genius on the copper side itself.
I think that's fair. Management did talk about cost control efforts, but the sheer size of that guidance cut points heavily towards those strong gold byproduct credits, especially since they mentioned prioritizing high-grade gold ore from Pampacancha in Peru.
Makes sense. It's still good news for margins, just important to understand the driver. So with costs coming down, what about the actual production volumes? Where are they landing versus expectations now?
Okay, so for the full year, consolidated copper and gold production, they reaffirmed guidance, but specifically said expected at the low end of the previous ranges.
Low end.
Yep.
On by region, any major shifts?
Yeah, a few key ones.
Yeah.
In Peru, at Constancia, copper is still expected to be in line with guidance, but gold, because they're pushing that high-grade Pampacancha ore you mentioned,
Yeah.
gold production is now expected to be above the top end of the guidance range.
Okay, so Peru's actually over-delivering on gold, helping those byproduct credits.
Exactly. But the other regions had issues. Manitoba, Snow Lake, their gold production is now expected slightly below the low end of the range.
Because of the wildfires.
Mostly the wildfires, yeah, but also an unexpected power outage in October added to the downtime there.
Okay. And British Columbia. Copper Mountain.
That's probably the main near-term operational concern right now. Copper production there is expected to be below the low end of its range.
Why is that?
Well, partly due to planned waste stripping, which lowers ore grade temporarily. But the bigger issue was unplanned maintenance on their main SAG-1 mill.
SAG-1.
Yeah.
That's the big primary grinding mill, right? What happened?
Sounds like damage to the feed head. Required some significant downtime for repairs. That kind of issue can definitely linger and impact near-term throughput.
Yeah, mill availability is always key. So that BC issue adds a bit of near-term uncertainty, even with the better cost outlook. Did they adjust spending plans in light of all this?
They did show some caution there, yes. They cut the total capital expenditure plan for the year by $35 million.
Where did those cuts come from?
About $15 million was deferred sustaining capital, so basic mine upkeep. And another $20 million in growth capital got pushed out to 2026. Seems like prudent cash management given the Q3 disruptions.
Okay, makes sense. Now let's shift gears to what you called the main event earlier, that Copper World deal.
Yeah, this is the game changer. The $600 million strategic joint venture with Mitsubishi. They're taking a 30% stake in the Copper World project down in Arizona.
And this is huge because
It fundamentally transforms the funding picture for Hudbay's biggest growth project. This deal does several things all at once.
Okay, like what?
One, it brings in a major credible partner in Mitsubishi. Two, the price they paid implies a really strong valuation for Copper World, likely well above what analysts had in their models, hence that impairment reversal we talked about.
Right, it validates the asset value.
Exactly. And three, probably the most important point financially, it massively reduces Hudbay's own funding requirement. Their remaining equity needed for the project is now estimated at only around $200 million.
Only $200 million for their share of a massive copper project. That takes a huge weight off their balance sheet, doesn't it?
Completely. It basically de-risks the financing question. And it pushes out Hudbay's first major capital contribution potentially to 2028 or even later. They get years of breathing room.
And the returns. I remember seeing a crazy number mentioned.
Yeah, you probably did. Because of this structure, the levered internal rate of return, the IRR, on Hudbay's remaining investment in Copper World, they're now projecting it at approximately 90%.
90% IRR.
Oh.
Okay, yeah, that explains why the market might look past 1 weak quarter. That's an incredible potential return.
It really is. It shifts the whole narrative.
So what's the timeline look like now for Copper World with this JV in place?
They gave some updates on the call. The definitive feasibility study, the DFS, which is like the final detailed engineering plan, that's expected mid-2026.
And then a decision to build.
Targeting a final investment decision, or sanction decision, late in 2026, with first production aimed for 2029.
Still a ways off, but the path is much clearer now. Are they spending money on it before that final decision?
Oh, yeah. They flagged about $150 million in pre-sanctioned spending plan between now, early 2025 and mid-2026. That's for things like detailed engineering, ordering long lead time equipment. They're moving forward.
Good to see. And quickly, what about other growth projects? Anything else moving the needle?
Yeah, a couple of things. At Copper Mountain in BC, despite the SAG-1 issue, the conversion of the other mill, the SAG-2 mill, is still on track for completion by December 2025. That should help boost throughput there significantly by mid-2026.
Okay, so some positive news out of BC too.
And up in Snow Lake, Manitoba, they're running their biggest exploration program ever, really focused on the Talbot in 1901 deposits, trying to find more ore to extend the mine life there. That's a key longer-term story for their Canadian operations.
Got it. Okay, so let's bring it back to the market reaction. The stock actually closed up 2.4% on the day HPM reported, right, after initially dropping pre-market.
Yeah, it did, which is pretty telling, isn't it?
It really is. What signal do you think investors were sending there?
I think it signals that the market looks straight through the Q3 operational noise. The wildfires, the Peru issues, even the BC mill hiccup saw them as temporary external problems.
And focus instead on?
Focus squarely on the big strategic positives. The dramatically improved cost structure, driven largely by gold credits, yes, but still improving margins. And crucially, the Copper World JV de-risking their main growth engine. The long-term story won out over the short-term static.
And that long-term story is playing out against a very favorable backdrop for copper itself, right?
Oh, absolutely. You can't ignore the macro picture here. Copper prices have been, soaring near record highs. LME copper recently over $11,000 a ton, up, 24% year-to-date roughly?
Yeah, huge move. Driven by
the energy transition narrative mostly.
Yeah.
EVs, renewables, grid upgrades, they all need vast amounts of copper. And the consensus view is that we're heading into a structural supply deficit starting maybe next year, 2025 or 2026. So Hudbay is positioning itself to deliver more copper right into that tightening market.
So the long-term strategy is clearly copper-focused then?
Hugely. Post-Copper World, whenever that comes online, they expect their total annual copper production to jump by more than 50% from today's levels.
50% growth.
Yeah. And the portfolio becomes much more copper-centric. Over 70% of their revenue is expected to come from copper. And importantly, it'll be diversified across Canada, the U.S., and Peru, 3 distinct geopolitical zones.
Which feels pretty important these days.
Definitely. So the core question for investors, it's really shifted, hasn't it? It's not, can they afford to build Copper World anymore? The JV answered that.
So the question now is...
Now it's, can they execute consistently and safely? Can they navigate the operational challenges like the current BC mill issue, finish the projects on time, and actually capture the benefits of this strong copper cycle that everyone sees coming? It's an execution story now.
Execution risk replaces financing risk.
Mm-hmm. Okay.
That brings us nicely to our regular segment. This is not financial advice.
Right. Got to put the disclaimer out there loud and clear.
Yeah, absolutely. So first, context. HPM stock has had a monster run, up like 80 to 105% year-to-date before these earnings.
Incredible performance.
And volatility is high right now.
Mm-hmm.
Near-term implied around 71%.
Yeah.
That BC mill issue is probably contributing to that nervousness.
For sure. So betting on them fixing everything perfectly in the next, say, quarter or two feels risky, given that mill problem.
Agreed. So the trade idea needs to look past that near-term operational uncertainty.
Right. It should focus on getting exposure to that de-risked, high IRR Copper World story, maybe even using the current high volatility to our advantage.
Okay, lay out the outrageous but plausible pitch. How do we structure that?
Okay, think long-dated options. Capital efficient. 2 steps.
Step 1.
Step 1. Sell the near-term fear. You sell an out-of-the-money put option, maybe expiring sometime next year, say November 2025. The premium you collect on that put will be inflated right now because of that high implied volatility, driven by the operational concerns like the mill.
Okay, so you collect cash by basically betting the stock won't collapse due to these temporary issues.
Exactly. You're selling insurance against a short-term drop that you think is maybe overpriced. Then, step 2.
Use that cash.
Use that premium you collected to buy the long-term growth story. You buy a long-dated call option, target an expiry date that lines up with the next big Copper World catalyst.
Like the feasibility study or the sanction decision in mid to late 2026?
Precisely. Mid-2026 feels about right. So you're essentially using the market's current anxiety about short-term operations to help pay for a bet on that 90% IRR project coming closer to reality in a year and a half or so.
So you're leveraging the spike in near-term volatility caused by the Q3 miss in the mill issue to cheaply finance a bet on the long-term strategic value unlocked by the JV.
That's the idea. Treat the Q3 noise as a temporary funding source for the long-term signal. Acknowledge the risk, but invest in the de-risked growth.
Interesting structure. Definitely capital efficient. Okay, let's wrap this up. What are the main takeaways from this Hudbay quarter?
I'd say 2 key things. 1, yes, operational headwinds, fires, unrest, mill issues. definitely impacted the key three results and created some near-term uncertainty, especially in BC.
Right.
But two, the strategic wins were arguably much more significant for the long term. The big improvement in cost guidance, even if helped by gold, boosts near-term margins. And that Copper World JV with Mitsubishi, it's truly transformational. De-risks funding, validates the asset, points to that incredible 90% IRR. The market clearly weighed these positives more heavily.
Yeah, the strategic narrative overpowered the operational one this time.
Okay.
Final provocative thought for you, the listener, to chew on.
Management specifically said on the call that with Copper World now largely funded, they're in an enviable position. They can fund Copper World and keep investing in their other projects, brownfield expansions, greenfield exploration.
Right, so the balance sheet pressure is off.
Yeah.
The question then becomes, what's next?
Exactly. With Copper World in a clear path, which of those other smaller growth opportunities gets prioritized? Is it the Snow Lake exploration, trying to extend mine life at 1901 or Talbot? Is it advancing the studies for the Mason project? Now that they have financial flexibility, where will the next major catalyst come from beyond Copper World?
Something to think about. Which piece of the pipeline gets the next big push?
The optionality across the portfolio just opened up significantly.
Okay, that's our deep dive on Hudbay Minerals. This has been Talk Tickers.
And remember, we analyze, we discuss, but this is definitely not investment advice. Always do your own research. Thanks for tuning in.